It has never been easier to spend money you don't have. Today, a world of instant credit is available right at your fingertips. Services like Buy Now, Pay Later let you split small purchases into 4 interest-free payments. Your credit card offers a safety net with a tap. Car dealerships advertise low monthly payments to make new cars seem affordable. These tools are marketed as smart, modern ways to manage money. They feel like a helping hand. Get what you need now. But this convenience has a hidden cost, a trap locking millions into debt. The illusion of easy money is just that, an illusion. On the surface, these options help, but the math often works against you. The global BNPL market exploded to $560.1 billion in 2025. Yet this growth hides a troubling trend. Recent data from LendingTree shows 41% of BNPL users made a late payment last year, up from 34% the year before. Easy payments aren't always easy. Consequences are surfacing for millions. Credit card debt hit $1.28 trillion in Q4 2025, according to Bankrate. Nearly half of cardholders carry a monthly balance. Average credit card rates exceed 22%. These numbers are a heavy burden on ordinary people. As reported by Protect Borrowers, roughly 111 million Americans are trapped in persistent debt. Statements pile up, escape feels impossible. We're pulling back the curtain on the math that keeps you in debt. We'll explore the rise of these credit tools. Then we'll walk through the cold, hard numbers, how a small balance can stretch into decades. We'll use a dark, instructional style with chains and traps to show how systems are built. But it's not about fear, it's about knowledge. Understand the math of the trap, learn the math of escape. Then we'll switch to bright, clear visuals for a simple, proven method to break free: the debt snowball. The core of the problem lies in a concept that financial institutions understand very well: the power of compound interest working against you. When you only make the minimum payment on your credit card, you are barely covering the interest that accumulated that month. Very little of your money goes toward paying down the actual principal, the original amount you borrowed. This creates a situation where your debt barely shrinks month after month, year after year. It's a slow, quiet financial drain that can go unnoticed until you are thousands of dollars and many years into payments. It's the central mechanism of the modern debt trap. The numbers are truly shocking. Research from the Century Foundation shows Americans accrue an extra $368,000 in credit card interest every single day. Think about that. Every 24 hours, the collective debt burden grows by more than $1/3 billion from interest alone. This isn't an accident. It's a feature of the system. A study from Get Out of Debt found a millennial with an average balance of $6,930 at a 22.83% interest rate, making only minimum payments would stretch the debt to about 26 years. Total interest paid: over $17,000 more than double the original balance. We'll later examine a Cura debt case study. A woman paid minimums for 8 years. Over that time, she paid more than $29,000 toward an initial $32,000 debt. After all that, her remaining balance was still $28,500. She'd only eliminated $30,500 of principal. Over $25,000 was eaten by interest. This is not rare. It's the math for more than 27 million Americans who can only afford the minimum each month. This discussion isn't to blame or shame anyone, it's to empower you with the truth. The financial system is complex, and convenient tools often hide mechanisms that favor lenders over borrowers. But there is a way out. The solution isn't complicated wizardry. It's a straightforward behavioral approach that puts you back in control. Understand the simple math that keeps you indebted, flip the script, and use simple math to get out. We'll show you how to break the chains step by step and build a brighter financial future. In the landscape of modern commerce, a new form of credit has rapidly taken center stage, promising a revolution in how we pay for goods and services. This is the world of Buy Now, Pay Later (BNPL). These services present themselves not as traditional loans, but as simple, smart payment tools. At checkout, both online and increasingly in physical stores, you are offered the chance to split your purchase into smaller, interest-free installments. The proposition is incredibly tempting. Get what you want today. Spread the cost over weeks or months. It feels less like taking on debt and more like a budgeting hack. A way to manage cash flow without the stigma or complexity of a credit card. This model has been wildly successful. The numbers tell a story of explosive growth. Global BNPL market growth, $560.1 billion in 2025. This wasn't a niche product for a select few. It became a mainstream option integrated into the checkout process of major retailers across the globe. For millions, the option to pay in full became as normal as paying with a debit or credit card. The psychological barrier to spending was lowered, encouraging larger purchases and more frequent transactions under the guise of affordability and financial flexibility. However, this rapid ascent has been accompanied by a deeply concerning trend. The very simplicity that makes BNPL so attractive also masks its potential dangers. While the payments are often advertised as interest-free, they come with a strict schedule. Missing a payment can trigger late fees, and for some providers, it can even lead to interest being retroactively applied to the entire purchase amount. According to a LendingTree report, this is a common pitfall, with a staggering 41% of BNPL users admitting to having made a late payment in the past year. This figure is up sharply from 34% just a year before, indicating that as more people use these services, the struggle to keep up with payments is intensifying. As inflation drove up the cost of living, especially for essentials, families have begun turning to BNPL for basic necessities. A recent LendingTree study highlighted this trend. 25% of BNPL users now use it to pay for groceries, up from 14% a year earlier. When a tool for discretionary spending is used to put food on the table, it signals deeper economic distress. Many households no longer have the cash for weekly shopping, forcing them to borrow to survive. This pivot from luxuries to essentials is a critical turning point. For a growing segment, BNPL is no longer a choice but a necessity. This creates a dangerous cycle. Finance this week's groceries, and you'll likely need to finance next week's, all while still paying off the previous week's loan. The danger is normalizing debt for consumables. Financing groceries leaves nothing but debt. The food is gone, the payments remain. That fundamentally alters the financial equation for struggling families. Splitting a $200 grocery bill into four $50 payments seems convenient until overlapping weekly payments and new expenses pile up. Section 3. The ecosystem of easy debt. It is the result of a carefully constructed ecosystem merchant platform, consumer. For merchants, integrating BNPL at checkout is a powerful tool to increase sales. Studies have shown that offering installment payments can significantly boost conversion rates, meaning more shoppers complete their purchases. It also tends to increase the average order value, as consumers are more willing to add extra items to their cart when the immediate financial impact is softened. The BNPL provider pays the merchant the full amount upfront, minus a fee, removing any risk for the retailer. For the BNPL platforms themselves, the business model is highly lucrative. Their primary revenue comes from the fees they charge merchants, which are typically higher than standard credit card processing fees. Retailers are willing to pay this premium because of the proven uplift in sales. A secondary and more controversial revenue stream comes from consumers in the form of late fees. When a user misses a payment, they are often hit with a penalty. While many platforms emphasize their interest-free nature, these late fees serve a similar function, penalizing those who are unable to keep up with the payment schedule and creating a financial cushion for the provider. This dual income model makes the BNPL business incredibly scalable and profitable. The consumer, of course, is the final and most crucial piece of this ecosystem. They are drawn in by the promise of simplicity, transparency, and instant gratification. The marketing is brilliant, positioning BNPL as a modern, responsible alternative to the perceived evils of high-interest credit cards. The process is frictionless, often requiring just a few clicks to get approved. For a generation that grew up with digital technology and is often distrustful of traditional financial institutions, this model feels intuitive and empowering. However, this symbiotic relationship creates a powerful momentum that can easily obscure the underlying risks. The merchant is incentivized to push more sales, the platform is incentivized to facilitate more transactions, and the consumer is incentivized to spend more than they might otherwise. Each party is acting in its own rational self-interest, but the collective result is an environment that encourages widespread indebtedness. The system is designed to maximize transactions, and the long-term financial health of the consumer is often a secondary consideration. It is a well-oiled machine for generating debt, one small, seemingly harmless purchase at a time, making it incredibly difficult for individuals to see the bigger picture until they are already caught. Section 4. The inevitable reckoning. For years, the buy now, pay later industry operated in a regulatory gray area, distinguishing itself from traditional credit products and avoiding the rules that govern them. This lack of oversight was a key factor in its rapid, unchecked expansion. Lenders were not required to perform the same rigorous creditworthiness assessments as banks or credit card companies. More importantly, BNPL loans were not typically reported to the major credit bureaus. This meant that a consumer could accumulate significant debt across multiple BNPL platforms without it ever appearing on their credit report, creating a shadow debt profile that gave other lenders a dangerously incomplete picture of their financial obligations. This regulatory loophole, however, is now closing. Governments and financial authorities around the world have recognized the systemic risks posed by the ballooning BNPL market. In 2025, a wave of new regulations began to take effect. In the United States, the Consumer Financial Protection Bureau moved to mandate that BNPL lenders report loan data to credit bureaus, just like credit card providers and auto loan providers. Similarly, the European Union revised its Consumer Credit Directive, and the UK's Financial Conduct Authority introduced rules requiring proper creditworthiness checks before a loan can be issued. The free-for-all is coming to an end. These new regulations have significant implications for consumers. On one hand, they offer a new layer of protection. Requiring affordability checks can prevent individuals from taking on more debt than they can realistically handle, potentially saving many from a cycle of late fees and financial distress. The mandatory reporting to credit bureaus also brings transparency, ensuring that a person's complete debt load is visible to all lenders. This can help prevent the overextension of credit. If a consumer is already struggling with multiple BNPL loans, a new lender will be able to see that and may decline to offer them yet another line of credit, which is a necessary safeguard. On the other hand, this change means that the consequences of using BNPL will become much more tangible and long-lasting. Previously, a late payment might only result in a fee from the provider. Now, under the new rules, that same late payment will be reported to the credit bureaus and can directly damage your credit score. A lower credit score can make it harder and more expensive to get a mortgage, a car loan, or even a credit card in the future. The easy credit that once seemed to exist in a separate, consequence-free zone is now being integrated into the formal financial system. For the millions who have grown accustomed to using these services without a second thought, the reckoning has begun. Table of Contents, Part 3, Act 2, The Hidden Cost of Minimum Payments, about 5 sections. Section 1, The Anatomy of a Credit Card Statement. Section 2, The Illusion of Progress. Section 3, The $5,000 Trap, a 25-year sentence. Section 4, The Devastating Math in Action. Section 5, Beyond the Numbers, the Human Toll. Section 3, The $5,000 Trap, a 25-year sentence. To truly understand the devastating power of minimum payments, let's walk through a clear, step-by-step example. We will use a hypothetical but very realistic scenario. Imagine you have a credit card balance of $5,000. This could be from a major car repair, a medical emergency, or the slow accumulation of smaller purchases over time. Average credit card APRs have climbed to record highs. We'll use a conservative rate of 22% for our calculation. Now let's look at the minimum payment. A common formula is 2% of the balance, or $25, whichever is greater. 2% of $5,000 is $100. So your first minimum payment due is $100. This seems manageable. You pay the $100, feeling like you've made a dent. But the hidden math begins its destructive work. Before your payment is applied, the card company calculates the month's interest. 22% APR divided by 12 gives about 1.83% per month. On a $5,000 balance, that month's interest is about $91.67. Now let's see what happens to your $100 payment. The bank applies the $91.67 to interest first. That leaves only $8.33 to go to principal. After you pay $100, your new balance is $4,991.67. You've sent in $100, but the debt barely budged, less than the price of a cup of coffee. This is the brutal reality of the minimum payment trap. The cycle repeats month after month, but the progress is agonizingly slow. If you keep making only minimum payments, how long until it's gone? The answer: just over 25 years. Over that quarter century, you'd pay more than $8,500 in interest. Your $5,000 debt would cost a total of over $13,500. That is the true, hidden cost of the minimum payment. Section 5. Beyond the numbers. The human toll. The mathematical reality of the minimum payment trap is staggering, but its true cost cannot be measured in dollars and cents alone. The burden of carrying this kind of persistent debt has a profound and corrosive effect on every aspect of a person's life. It is a constant source of stress, a dark cloud that follows you from the moment you wake up to the moment you go to sleep. Every financial decision is filtered through the lens of this debt. Can we afford this outing with friends? Can we handle an unexpected car repair? Should we put off a visit to the doctor? The debt limits your choices and shrinks your world. This financial pressure inevitably spills over into relationships. Money is one of the leading causes of conflict for couples, and a long-term, unyielding debt is like pouring fuel on that fire. It creates tension, arguments, and blame. It fosters a sense of hopelessness that can strain even the strongest bonds. For the 111 million Americans that Protect Borrowers identifies as being trapped in this cycle, debt is not just a line item on a budget. It is a daily emotional weight. It erodes self-esteem, making people feel like failures for being unable to escape a system that was designed to ensnare them from the very beginning. Furthermore, being perpetually in debt robs you of your future. That money could have been invested for retirement, saved for a down payment on a house, or used to start a small business. It is the cost of lost opportunity. Instead of building wealth for your own family, you are spending decades building wealth for the bank. The minimum payment trap doesn't just steal your money. It steals your dreams and your ability to create a secure financial future for yourself and your loved ones. This is why understanding the math is so critical. It is the first step toward reclaiming your life from the grip of debt. The numbers are not meant to discourage you, but to arm you with the truth. They reveal that the slow pace of your progress is not a reflection of your effort or discipline, but a consequence of a flawed strategy. Making only the minimum payment is a game you are mathematically guaranteed to lose. Recognizing this fact is the turning point. It is the moment you stop playing by the lender's rules and start creating your own plan to break free, a plan that puts your financial well-being first. Table of Contents, Part 4, Act 3, High-Interest Car Loans and Other Traps, about 5 Section. Section 1, The Lure of the Low Monthly Payment. Section 2, the 6-year loan for a 5-year car. Section 3, the upside-down trap and negative equity. Section 4, the ripple effect of a bad auto loan. Section 5, red flags at the dealership. After walking through the darkness of the debt traps, it is time to turn on the lights. Buy now, pay later. Minimum credit card payments. Long-term car loans. Designed to keep you paying for years, draining your income and your hope. The math behind these traps is powerful, but there is another kind of math, the math of escape. This is not some complicated formula or a get-rich-quick scheme. It is a straightforward, common-sense plan that has helped millions of people get out of debt for good. It is called the debt snowball method, your key to breaking the financial chains that have been holding you back. The debt snowball method is about behavior and momentum, not just numbers. Some financial experts will tell you to pay off your highest interest rate debt first. That sounds logical on paper, but personal finance is only 20% head knowledge. The other 80% is behavior. If you start with your biggest, highest interest debt, it might take you years to pay it off, and it is easy to get discouraged and give up. The debt snowball works differently. You focus on quick wins to keep your motivation high. With this method, you list your debts in order from the smallest balance to the largest, without worrying about the interest rates. This simple shift in focus is what makes all the difference. The psychology behind this is simple, but profound. When you attack your smallest debt first, you can often pay it off in just a few months. That victory, that feeling of crossing a debt completely off your list, is an incredible motivator. It proves to you that you can do this. You see tangible progress right away, which gives you the energy and the hope you need to keep going. It's about changing your mindset from one of hopelessness to one of empowerment, one small victory at a time. This is where the visual of our journey changes. We leave behind the dark imagery of chains and traps. We are now moving into the bright green territory of solutions and progress. The debt snowball is named for a reason. Imagine packing a small snowball at the top of a hill. As you start to roll it, it picks up more snow, getting bigger and faster as it moves. That's exactly what happens with your payments. You start small by knocking out your tiniest debt. Then you take the money you were paying on that debt and roll it onto the next one, creating a larger payment snowball that grows with each debt you eliminate, allowing you to attack your larger debts with increasing force. Keep going like that and, well, momentum builds and it gets easier. Section 2. Your first steps to freedom. Understanding the problem is the first step, but action creates change. The journey can feel overwhelming, but it starts with simple actions today. You don't need to have it all figured out. You just need to take the first step. First action. Stop the bleeding. Stop using buy now, pay later for non-essential purchases. Pause any new spending on your credit cards. You cannot dig your way out of a hole if you keep digging. That decision creates the space to start making real progress. Second action. Face the numbers head on. Take an hour this evening. Grab your latest credit card statements. Use an online calculator to determine your timeline. Find out how long it will take to pay off your balance. Find out how much interest you'll pay. This is not meant to shame you. It's meant to ignite a fire within you. When you see in black and white that a $3,000 balance will take 18 years to pay off, it turns an abstract worry into a concrete enemy you must defeat. This clarity is a powerful motivator. Third action. Start your debt snowball this month. Don't wait for the new year or the perfect time. The perfect time is now. Create your list of debts, from smallest to largest. Find one small extra payment, even $20 or $50. Send it to your smallest debt before the due date. This single act is you declaring war on your debt. It's the first snowball you pack at the top of the hill. It may seem small and insignificant, but it's the start of a powerful force. With consistency and intensity, it will grow to crush every debt. Regaining control is a series of small, intentional choices you make every day. You have the power to change your financial future. Replace the old math with a new math of focus, sacrifice, and momentum. It won't be easy, but it will be worth it. By taking these first steps, you're no longer just a passenger. You are taking the wheel and charting your own course toward financial peace.